Do you have highly appreciated stock? And if so, what's the exit strategy? Is it just to hold it? Don't worry about the risk. Don't worry about the taxes. Well, if you would like to diversify and you'd like to be able to deal with the tax problem, in this episode, we talk about specific strategies to help you do just that.
We hope you've been enjoying all the episodes from the Secure Your Retirement podcast. If you'd like to keep learning and receiving these episodes, then hit the subscribe button and turn on notifications by hitting the bell so you receive alerts when each episode comes out. We've helped thousands of listeners get on the path to securing their retirement. Now it's your turn. Let's dive in.
So, Nick and Merce, we've been talking a little bit about this idea of this appreciated stock, and you know, I guess we could if, just to first of all, just to kind of catch everybody up on our conversation. When we talk about highly appreciated stock, what we're talking about in very simple terms is somebody who has owned a stock that was valued at X. Let's just say if I had a stock that was valued at $100 and now it's worth $2,000. That would be considered a very highly appreciated stock, and there are issues with that we have to deal with, especially when it comes to diversification as well as when it comes to the tax ramifications. And I know, Nick, you've been working with some clients here recently where you're seeing this kind of, I guess, more commonly. And I'm curious, could you just share kind of some of those cases that you're seeing and what that looks like?
Yeah, so it has been a very common conversation over the last few months, I would say. And so one case in particular is a situation where someone's been working at a company. Typically, lately, it's been large tech companies like IBM, Cisco, Intel, and they've been granted company stock for many years. Most of the time, that's due to their position at the company. And so, as those stocks or restricted stock units have vested, they've been able to save those stocks and basically watch them grow over the last few years. And so, what's happened more recently is that so many of these stocks, like IBM, Cisco, Lenovo, have all just skyrocketed in the last few months, and especially since the beginning of this year. So the conversation has been, how do we strategically diversify, keep the portfolio diversified, and make sure that we're not running into huge tax ramifications? Because now a lot of the situations are, while that company stock used to be a smaller portion of someone's retirement plan, now it's a lot larger of a portion. So the ramifications, the risk has gone up for many of our clients, and so we're having conversations around that.
Yeah, Nick, that's a really I think that's a very common thing. Even, those companies you mentioned being local to here in this area, but I think there's quite a few investors that are whether they were granted it like you were saying, or they just, bought it, hopped on whatever bandwagon, and those big names like the Nvidias and the Teslas and all of that, it's a similar boat that a lot of people are in where they bought it low. It grew, especially over the last 4 or 5 years, it grew significantly. And now you're like, well, what do I do? And we often call that the golden handcuffs of, hey, I've got a stock that's been really, really good to me, but now I feel stuck with it. And I may still like the company, but I'm starting to, do you see that they're starting to realize that that number that they had 5 years ago has gotten maybe too big? And what are they feeling? What are they saying to you?
Yeah, absolutely. So it was I would say a slower move in terms of the stock over the last few years, but then more recently it's been a lot quicker of a move. So we have gotten into conversations where some of our clients have been working for these companies for 10, 20, 30 years, and they say, "Hey, I've had this stock here and I've been holding on to it mostly as kind of a hedge against everything else I'm doing, and I know the company and I'm very familiar with it, but it wasn't necessarily anything that was a huge part of the portfolio. So now it's one of those things where sometimes it's an emotional decision to sell the stock because we've been working there for so long, but other times it's more of a situation of we don't want to run into a huge tax bill. So that is the biggest concern. It's how do we strategically start to diversify out of this stock. It's great that it's done well, but the tough part is now there's taxes that may be incurred. So how do we do that from a tax standpoint?
Yeah, I think what I've seen in this case, and I mean, I'm thinking right now of a couple of families. You mentioned IBM, and it could be any company, but sometimes the story is, I went to work for IBM. I worked for them for whatever, 30 years. And honestly, a lot of my net worth right now came from this IBM stock. And so it starts to kind of feel like it got me here. Why would I now give up on it? And so sometimes I think people get in this emotional thing like, well, wait a minute, I wouldn't be worth what I'm worth right now if it wouldn't have been for this IBM stock. And so what we're talking about there is the difference between growing money when I'm younger and then making it last throughout retirement. So how do you talk to somebody when let's just say that if I've got a portfolio, and we can make up numbers here, but I got a portfolio, let's say it's $2 million, and 1 million of my 2 million is in an individual stock, which we see that all the time, where they've got half their net worth, half of their assets in one stock. You know, what's the difference, or how do you explain the difference to somebody about the that concentrated risk when I'm at retirement age compared to when I was 30, 40, even maybe in my early 50s? Now here I am, I'm 60. What's the difference? Like, how do you explain to them that this is a different story today than back when you were building this? Because you could have lived through the downturn back then.
Right, right. When we're working and we have a salary and income coming in, if a stock goes down 20, 30, 40%, even though it is a large portion of the portfolio, it's not as big of a deal because there's still income coming in the door. That's the biggest thing when it comes to retirement, making sure there's still an income plan there. So, when it comes to actually being retired and relying on that money, well, that's a whole different story. So now it's a matter of intelligently investing the funds, but making sure that they can last. And so these are big companies. A lot of the times we're not concerned about them going out of business, but what we are concerned about is a big, fast run up in the market and not taking advantage of that opportunity. So there are significant opportunities that come up, and then there are other situations where there could be bad times down 20 or 30%. So it's just wrapping our heads around maybe we take advantage of this good opportunity now because it will help in retirement in the long run, and essentially make those assets last.
I know you might have something, Merce, but before we get to that, I got another thought that I just wanted to add to this conversation about this concentrated stock. And I think what's different. So let's go back to what you said, Nick. You said, when I'm younger, I could have let it go down 30 or 40%. So let's go back to my $1 million. If I got $1 million and I'm working and I don't need the money for another 15 years, right? And it drops by 40%. And I know long term, I believe in the company, I believe in the concept. It should not bother me. I know that long term, this company is going to come back and it's going to grow. And I don't need access to money. The difference is when I'm in retirement or close to retirement, I need access to money. So if I had $1 million that now went down to say 600,000, I've lost access to the 400,000. And I now say I can't live on that money. I have to let it come back because if I start withdrawing now from the 600,000, the compound effect of that is huge. And I think people have, they start to get that in their head. If I say I got this $1 million and I don't need to touch it, period, for the next 10, 15 years, stay in the company if you want to. But most people that are in retirement are saying, I got this asset that needs to be able to provide. So I just wanted to add that. And that's what access to money is really important when we're thinking about retirement. So go ahead, Merce. I'm sorry if I cut you off there.
Yeah, so what I was going to say in kind of relation to what Nick just brought up is you've got this stock that grows, and what we've all kind of talked about with people. I think an easy way to envision it is this idea of taking chips off the table. It's a common phrase that I think all of us use. But what does that really mean? And if you kind of think about chips on the table, that's really a poker type of or a gambling type of comparison. But when you're up, a lot of times it makes sense to start taking some of those profits and putting them in your pocket or redeploying them into something else. That's kind of the concept. So that if there was an issue, if you got a few bad hands, you've got money in your pocket and you're not going all in on some bad hands that you just don't know what's going to happen, right? So I think with the stock market itself, like if you look at this year in 2026, midway that we are, the stock market is up and somehow it's up, right? I think a lot of people would say that it doesn't make sense that it's up because of what we're dealing with inflation and the Fed and things going on in the US and things going on outside of the US geopolitically and oil and all this stuff. And it doesn't make sense that the market is up, but the market is up. Now, the market is up because of a handful of different stocks. And if you were to look at if you were to look and kind of choose it and see there are plenty of stocks that are down in this realm of say 30 to 50% for the year, right? And so that I think is what the sometimes the investor can ignore, which is the individual risk when you hold individual stock, right? If you're holding the index, I mean, how often do indexes go down 50%? It's not all that common. The last one we would look back to is like a 2008 where the indexes were down that much. So it happens, but not all that often. But how often does a individual stock go down 30 to 50%? I mean, it happens every single year, right? So when you kind of frame it that way, the idea of taking chips off the table starts to make a lot more sense. Especially like you said, Nick, is as we get closer to retirement and we start to need that money. Now the question becomes is how do we do this? So Nick, in your financial planning and tax strategy types of meetings, what are the things that you're saying so that I'm the client and I say, yep, I totally agree. My million in IBM, we need to do something. How do you approach that conversation?
Yeah, so our biggest approach is really on a tax standpoint. So how do we strategically sell out of that IBM stock or whatever it is, Cisco, Intel, and make sure that we're not running into a huge tax bill. And so a few ways that we do that, we're strategically looking at other income sources year by year, so we can kind of take advantage of where someone is in from a tax bracket standpoint in a given year, and that's different for everyone. So that's a very individualized practice into what is going on in this year in particular and how much can we potentially sell out of a stock at a low tax rate. So we can do that in any given year. And then we also have strategies to help with selling out of these highly appreciated positions. So things like tax loss harvesting that we've talked to many of our clients about. And so that not only, and what that is, just in a nutshell, is in very high level, is essentially using other funds that are non-IRA money to invest in the stock market and over time accumulate losses that are going to help offset gains from somewhere else. And so we have many clients who are accumulating losses in their accounts that is going to help and works perfectly for a scenario of selling out of a highly appreciated stock in any given year. So that's a
Hey,
big strategy that we're using too.
hey, by the way, on that one, because somebody hears generating losses, uh, are we doing that generation of losses at the detriment to the return of the portfolio?
No, that's a good point. So, the way that is essentially working is we are trying to, or essentially mimicking an index. So we use the S&P 500 just as an example a lot. So if we broke open the S&P 500 and said, out of these 500 stocks, or how are they doing? Are they all positive at any given point? And so the answer is no. In all of those 500 stocks, there are some that are at a gain. There are also some that are at a loss. And so if we're going to be able to mimic the S&P 500 in whether that's any given year, there are going to be stocks at a loss. That's just kind of how it works in any sort of index. And so that's not just out of purpose, that's just going to happen. And so we take advantage of those losses because we just can't get away from them. They're going to happen if we're tracking an index. So that's how we essentially accumulate the losses as they come up. And they can come up throughout any time during the year, potentially downturns. But even in a normal environment, like Merce said, the stock market's up this year, but there are many stocks that are at a loss. And so those losses help to offset the gains on the stocks that are doing really well. And it helps us to diversify. So we've been able to accumulate losses of 10, 20, 30,000, even while accounts are tracking the S&P 500. And so with that, we can sell out of an IBM stock, for example, that has 30,000 of gains with no tax consequences to the client. So these are kind of huge tax savings just from a strategy that we're doing outside of that stock, which helps the client every single year going forward.
Yeah, it is pretty cool. That strategy of direct indexing with tax loss harvesting. It's pretty cool to be able to say, hey, the S&P was up 10 and I was up around, 9 to 11. I did pretty much what the S&P did, but also I was able to trim my IBM position at a next to no tax ramification. I mean, that is pretty special. There's not many other ways to do that. Although I know, Nick, when we talk about you've got other strategies too that come up pretty common for some that are charitably inclined. In a nutshell, how do those work?
Yeah, so for someone who is charitably inclined, the way we're looking at that is essentially there is something called a donor advised fund. And so for what's called a donor advised fund, and this is typically a someone who could create their own account at a broker like Charles Schwab or Fidelity, and it's their own charitable fund. And so instead of what people typically do, which is um, pay taxes on money that they receive from a salary or from a distribution and then donate to a charity. What we do with a donor advised fund is we are donating the highly appreciated stock at a 0% tax rate. So with that fund, we can put the stock right into, and typically we're using the most highly appreciated position or a purchase of that stock, and we put it right into a separate account without any tax consequences. And then so our clients are able to donate that stock without paying any taxes on the gains, and they can donate that full amount of the stock. So that's also for someone who is charitably inclined, a very, very important strategy to take advantage of highly appreciated stock and not pay any taxes on the gains.
Yeah, so I think what we try to make sure that clients know is that if you just stay in this place of doing nothing, you only are compounding the problem. It's not getting better. You know, you could just continue and say, I just don't want to deal with it, but that doesn't solve it. Just because I don't want to deal with it doesn't mean it's going to get better. And so what we're trying to, I think, throughout this conversation, as well as when we're talking to clients, is to say, hey, let's come up with a plan to try to say, how do we diversify? How do we reduce the risk? How do we deal with the taxes? We've got strategies. We actually have more tax strategies that we can't even go into right now, just based on time, that we can talk clients through that says, hey, we can do this and keep you in a low tax bracket, get you diversified, and be able to help you in this situation. But I think ultimately, what I think we can close out with is that if you're listening to this and you are in that kind of situation, um, schedule a call with us. And so it's pretty easy. All you got to do is go to our website, pomwealth.net, and you can just click anywhere in there and you can schedule a call. Our calendar will come right up and you'll be able to schedule that conversation. And then we can look at your very specific situation. We're talking very generalized today, but if you're in that scenario and you go, I want to see what my situation looks like, with our software, we're able to show you a very specific plan for your situation. But I enjoyed the conversation, guys, and I hope maybe that this has helped people. So thanks for hopping on.
Yeah, absolutely.
Yeah, thank you.
If you would like to find more information about Peace of Mind Wealth Management, we invite you to visit our website at pomwealth.net. If you go to the contact page and contact us, we'll send you a free copy of our book, The Peace of Mind Pathway. It lays out our process from beginning to end. Please visit our website.
For more retirement tips, check out these videos. Also, if you find them valuable, please subscribe to our YouTube channel and give us a like.